Hello, everyone. Welcome to VRIC Media, your most trusted voice in metals and mining. I'm your host, Daryl Thomas, and today we have the pleasure of meeting with Adrian Day of Adrian Day Asset Management. Today, we cover the royalty and streaming business model, and we go a little bit more in depth about the model. So if you are a new investor in this space or want to learn more about the royalty and streaming model and how it differs from the mining industry, be sure to click the link in the description below to the Commodities University. In this university, we have multiple courses on commodities as well as mining, geology, and Adrian Day himself has a Royalties 101 course. So be sure to click the link in the description below. Be sure to use promo code AdrianDay50. That is ADRIANDAY50, all caps. If you use this promo code, you will get it at the discount. So look forward to seeing you all in the commoditiesuniversity.com and on to the interview. How you doing today, Adrian?
I'm fine, thank you. And you?
I'm doing well. I always enjoy running into you at the symposiums and everything, and always appreciate having conversations with you.
And you.
Yeah. So want to start with just your overall outlook on gold. Where do you think we are at in this bull market?
You know, I think we're still near the beginning, to be honest. And that might sound pretty odd to some people when they look at the last 3 years. They say, gosh, gold's been going up for almost 3 years, October 22. The gold price had doubled. The stock prices have doubled. The stock prices are up 77% this year, the senior ones. But I think we're still near the beginning. And the reason I say that is that all of what I think of as the traditional reasons that people, investors, particularly North American investors, were invested in gold and gold stocks historically in the 70s, in the 2000 to 2009, 2008, 2009 to 2012, and so on. But the reasons that people were investing in gold historically are still not in place today. And by that, I mean a weak economy, low and lower interest rates, a high and increasing inflation, and a weaker US dollar. Now, we've had a weaker US dollar this year, but on a historical basis, it's still relatively high. But if you look at interest rates in the US, they're still high. If you look at the economy, it is still supposedly strong. The narrative is that it's strong. And so all of the economic narrative, certainly up until recently, has really been the opposite of what we look for when we look for people investing in gold. And if you look at the flows into the gold funds, for example, the GDX, which is the largest of the gold miner ETFs in the US, up until the last week, it has just been consistent outflows. $114 million has flowed out in the last month. $3.5 billion has flown out this year. When you're looking at a fund that only has $16 billion in assets, that's very meaningful. And so I don't think the US investor has even begun to flow in, the generalist investor. Obviously, gold investors are in it. But the generalist investor has not even started to invest in gold yet.
Got it. What factor do you think gold measured in the S&P it's been outperforming the S&P 500. However, the S&P 500 is at all-time highs. Do you think that plays a factor into the generalist investor getting into gold?
Absolutely. No, that's a good point. I mean, when I was talking about the economic environment, that really affects the interest in gold generally, gold and gold assets. But you add to that the fact that the S&P is moving up month after month after month. We all know that the valuations are high. We know that the breadth is very narrow. The market's being driven by a small number of stocks. We know that the insiders are dumping their stocks. But the index itself continues to go up month after month. And so if you're a regular investor, right, not a gold investor, you're just an investor, you're a dentist in Oklahoma City or something, Your S&P's going. Your brokerage statement shows that you're going up every month. You just don't see. You're just not looking at gold at the moment.
Mm-hmm. Got it. And so, okay, so we have that from the investment standpoint. I want to get your take on just kind of the what sentiment are you seeing around the disruptions, and there's a lot of trade policy conflict. There's also we've been having the executive order that was recently signed to allow for I guess gold is a traditional asset, but other assets to be added to like retirement funds or such. And so, what do you think the sentiment is there, and what kind of doors does that open for investors, especially in like retirement portfolios?
Yeah, no, that's an interesting and broad question. I mean, I think, I mean, clearly there has been an awful lot of uncertainty about what policies are going to come, and then also just uncertainty about the policies, flip-flopping backwards and forwards, particularly for trade policies, flip-flopping backwards and forwards, and that uncertainty leads to volatility. And you see that on the part of businesses as well. Businesses just not sure what to do. And when a business sees an uncertain outlook, then they're going to be much more reluctant to make new decisions, to open a new plant, to hire new people. You just kind of bunker down and stay where you are. I think to some extent that sort of uncertainty, although the uncertainty remains, I think the market is taking less notice of it now than it was in the past. But with regard to, you asked about, opening up 401ks to private equity. That's part of it. I think that's part of what you were asking about, opening up retirement accounts to private equity, opening up, the passage of the so-called Genius Act that allows light regulation on fully backed stable coins. I mean, I think all of these things are they're twofold. One is they're part of an underlying sort of philosophy or approach, if you like, to sort of have less regulation and to open up markets generally. And that's certainly an approach that we're seeing after the Biden years, but also really the last 12 years, 15 years since the great financial crisis, when regulation upon regulation upon regulation has just been piled onto the financial sector. And so there's certainly a backlash against that. But some of these things have very, very specific drivers. I mean, the driver to have a light touch on stable coins, if they're fully backed by the treasuries, is clearly an attempt to find another source of buying for treasuries. Mm-hmm. Because the treasury market, as you know, a lot of the traditional buyers of treasuries, particularly foreign official buying, the Chinese government, the Japanese government, they are buying a lot fewer treasuries than they have in the past. And in fact, the two I just mentioned, Japan and China, which are the two largest foreign holders of treasuries, are net sellers now. So I think there's a drive on the part of a treasury to find other sources of buying for treasuries, and the stable coins is certainly one of them.
Yeah. I was reading an article. Totally agree with you on the stablecoin issue, because our government does need people to buy the debt. They need a buyer of the debt to finance the spending. And so when it comes to some of the retirement aspects of what was signed, there was a mention of gold. And so I was kind of wondering, I mean, how new is that? I mean, we've had gold IRAs, we've had, vehicles for people to be able to invest in gold and put that in a retirement portfolio. And so I was kind of wondering, is that a shift in the industry, especially for you as an asset manager and such? Was that anything different than what you've been doing, pretty much, to simply
Well,
put it?
look, to be honest with you, I don't know. I haven't seen what you're referring to.
Okay,
I mean,
got it.
certainly they're opening up gold like it's a tier one asset, so banks can hold it as a reserve. As you say, we've had gold IRAs for a long time. I mean, personally, I've never seen the point of putting physical gold into an IRA because an IRA is tax protected or deferred, and so gold, which famously is an asset that doesn't pay a dividend, well, you don't really want to put that inside a tax shelter. You want to keep that outside and put things that pay dividends inside your IRA. But nonetheless, as you say, there have been gold IRAs for a long time. But all of these shifts, with regard to the banks, for example, holding gold as a reserve, I mean, they do take time. They take time to work through, big institutions before it becomes. So we haven't really seen much impact of that of that one yet, but it just takes time to work through.
Yeah, got it. So yeah, thank you for sharing that. Right now I got an expert in front of me, so when I read these headlines, I just got to bring it up. Like, hey, is this something we should be thinking about or whatnot? So I'm glad you spoke to that.
I mean, the truth is, as you know, this year, particularly since January the 17th, this year we've had headlines every day, and It's difficult to just keep up with them all.
Yeah, agreed. So just thinking about an investment vehicle. So one of my favorite investment vehicles for gold is the royalty and streaming space. And you recently collaborated with the Commodity University and put out a course on royalty and streaming companies. And so I want to dive into that model a little more today. I encourage our viewers to go over to the commodityuniversity.com. And you can also get a promo code if you use Adrian Day 50, all caps, and you can become a member at the Commodity University to check out the course. But I do want to talk about you've been around for a while, and you've been in some very prominent situations. So I've been an investor in Franco, Nevada for a while, and you were there at the beginning of it. And I had no clue about this. Like, I'm interacting with you at the symposium. I have no clue what connections you got or whatnot. I hear you speak on the stage and we talk about your ideas and outlook on the economy and such, but I did not know that history. And so could you speak to that a little bit?
Yeah, sure. Well, back in the early 1980s, I had a good relationship with a Canadian Toronto money management firm, Cavelty Capital. Peter Cavelty is still around, but we were invited to sit on a board of directors of the Dynamic Gold Fund, which included Ned Goodman and Mr. Boutel. I forget his first name, sorry. And anyway, in that association, I got to know Pierre Lassonde quite well because he worked for Boutel Goodman at the time. So I got to know him quite well. And we had a good relationship, and he acted as a bit of a mentor for me, always sort of helped me out. And when he left Boutel Goodman and he and Seymour Schulich set up Franco-Nevada, I was one of the, early investors, one of the seed investors in that, or not seed, but one of the private placement investors in that. I think it was 35 cents or 25 cents. I can't remember, and that was, of course, there've been many, many splits since then. And then, of course, subsequent to that, they merged with Newmont Mining. I think that was 2002. They merged with Newmont Mining, and then Newmont spun it off in 2008. So, it's really, and they spun off the same assets. So it's the same company, but technically, there was that break in the middle there. But it's interesting. I remember going out 1987. We did a tour of their Nevada assets, and they showed us Hasbrook Hill that they thought was going to be some great discovery and so on. But as we all know, it was the royalty they had on Goldstrike, which laid the foundation to the company. And that came about almost, I won't say by accident. It wasn't by accident, but it certainly wasn't the main focus of the company when they set it up. So the royalty business has been, I mean, there's been royalties, particularly in the oil and gas business. There's been royalties for 100 years, but no one had ever thought of putting together a public company to go out and acquire royalties and subsequently to create royalties. It was Seymour Schulich, who had a background in, whose background is in oil and gas, who thought, well, hey, if we can have oil and gas royalties in public vehicles, why can't we have gold royalties in public vehicles? And initially, all of the royalties, both for Franco and then also for Royal Gold, which was a U.S. company, one of the early royalty companies, they were all what we call legacy royalties, right? You know, a rancher would sell his land or his surface rights to VRIC to do exploration, and in return he got a royalty, and they would be passed down in the family. So the legacy royalties existed, and at first Franco and then Royal would go out looking for legacy royalties to buy, to put into each of those two public companies, and it was a very, you know, it was obviously an attractive idea because the rancher, you know, maybe the rancher had died and the son, you know, the heirs, the children, you know, they weren't interested in this royalty that had been in the family for 20 years and had never paid a penny. They were happy to have someone come along and pay them some money for it. Obviously, the business has developed an awful lot since then. And so although you still get legacy royalties being purchased, being acquired by royalty companies, it's amazing to me that after 45 years, nearly 50 years of you know, high activity and competitive activity, that there still are legacy royalties around. But of course, increasingly, royalties and streams, their cousin, are now created. You know, Franco or Wheaton will go to the company and say, hey, you need money, we'll give you capital. In return, we want, you know, a share of the gold or silver or whatever. And they create a royalty. But ones that are created have better conditions and criteria attached to them, because, of course, you can negotiate those. When you just buy a legacy royalty, you're buying it from Joe Doe, who's Jim Smith, who's the rancher. You just take whatever conditions are on that royalty. You're not negotiating with the company. But when you negotiate with the company, you're obviously able to negotiate, but you're able to negotiate the terms and conditions that you want on a royalty, which is very important.
Yeah, that's important history there. Thank you for sharing that with us.
The copper market, of course, is the biggest metal market on the planet. You know, 200 to 300 billion globally of metal traded. Following majors around and picking up projects that they jettison can lead to great success in this business. Vizsla Copper, we're the team that brought you successes including ISO Energy and Vizsla Silver. If you want to learn more, you can find us at vizslacopper.com.
So with this model, what really drew me to it was really the amount of cash that's typically generated, revenue that's generated, as well as the less amount of risk. But just breaking down the model a little bit for those investors who may not be aware. So a royalty company is essentially like an investment bank for miners. Is that correct?
Yeah, you could look at it that way. Yeah. I mean, they're in the financial business more than in the mining business, that's for sure. So a royalty or streaming company, and when I say royalty, I'll include streamers unless we designate otherwise. You know, they provide the capital. They're a source of capital to explorers, to developers, and indeed to producers. And over the last 40 years, the business has gone through, at different times, Most of our royalties and streams are focused on one particular type of company. So after, let's say, 2013, 14, 15, when the big global base metal miners were having difficulty and their balance sheets were being stretched, Franco and Wheaton were able to come in with, $500 million, $1 billion to repair those balance sheets, and in return, get the byproduct gold or silver that the big base metal companies were producing. That business isn't there anymore because the big global miners are in very good shape. They don't need to give away. But nonetheless, you've got explorers, developers, and producers who all at different times for different reasons. And with a producer, it might be for an expansion. It might be just to raise capital for other assets. We just saw that last, 2 weeks ago with First Quantum, when they sold a stream for $1 billion to Royal Gold on a copper mine in Zambia. And that was just to raise capital for other issues, repair their balance sheet a little bit because of the problems that they had in Panama. And the key is that these are capital providers. And so they're competing against, not just against other royalty and streaming companies, but they're competing against banks offering debt and against equity markets, for the companies to raise equity. And all of these things have pluses and minuses. I mean, with debt, you can repay the debt and then it's gone, but it is, a significant amount of your revenue rather has to go to repay the debt right off the top. Equity, of course, can be highly dilutive, and if you issue, however many shares, if you issue 50 or 100 or let alone $1 billion worth of shares, that dilution stays with you forever, right? Unless you buy them back at some point. And streamers, of course, you're taking money off the top. So all of them have some kind of, from the company's point of view, all of them have some kind of dilution. And that's just inevitable. If you're building if you're exploring or developing or building a mine, you need to get your capital from somewhere.
Yeah.
Right. And so royalties and streams have simply become a very traditional and an accepted form of capital. And any major financing package now, any major financing package for development of a mine will include some equity, some debt, and some stream. And how much of which really just depends on the state of the markets. I mean, right now, until right now, certainly for the last couple of years, banks have been kind of reluctant to lend money to development assets, and particularly in certain jurisdictions. Equity markets, of course, have been a lot more friendly in the last year. And so whereas 3 years ago, 4 years ago, companies really didn't want to issue equity, they would prefer to take debt. Now they're quite happy to issue equity, especially when the banks are more reluctant to lend money. So it all comes and goes at different stages. But it's really just a way of financing. The benefit, as you touched on, I mean, there's a few benefits, but the huge benefit for a royalty company over the mining company is what they used to say, first money in is last money in, meaning you're making an investment and you're not responsible for ongoing capital expenditures, ongoing fixing things that go wrong. You're not responsible if the local host government decides to raise taxes. You're not responsible to deal with all the environmental problems, et cetera, et cetera, et cetera. And so from a risk point of view, as you said, all of that means that that royalty companies are a much lower risk business model and therefore much lower risk stocks, so a way of getting exposure to the sector at much lower risk.
Mm-hmm. Yeah, thank you for breaking that down. And so I was thinking about the banks when banks are reluctant and miners and explorers and such, they need capital. Typically, this is where the royalty streaming companies would step in to provide that capital. And so what stage projects are typically, is it every stage of the chain as far as like early exploration to developers to those that are already producing? What stages typically are royalty and streaming companies and financing?
Yeah, well, for the industry or the sector as a whole, it's spread throughout everything. But, certain companies like Triple Flag, for example, which is one of the newer ones, one of the newer large ones. I think that's the fifth largest now. But 2020, I think it started. 2021, it started. They will focus on either producing or near producing. So things where you can say with a high degree of certainty within a very short period of time will be producing. All royalty companies prefer producing or near producing, but of course, for producing assets, you're paying a much higher price. The competition is much higher, and so the stated returns are going to be a lot lower. But there are royalties on exploration ground. Typically, you will get those more often than not. You will see those in the smaller companies, or you will see them when a larger company buys a package. So it might be Triple Flag, for example. Triple Flag bought out Mavericks royalty company, which itself was started with a package of royalties inside Pan American. And that package included some producing, and it included a lot of royalties on exploration ground. And so they acquired the package. You do see that. Occasionally you'll see a company, occasionally you'll see a larger company buy a royalty on an exploration or non-developmental asset, something that hasn't even started yet. Wheaton, for example, put in, I think it was 25 million, which for them is a tiny investment.
Yeah, that's peanuts, right?
Yeah, it's peanuts, but they put that into buying a royalty. And again, they typically buy streams, not royalties, into a royalty on Vista Gold's Mount Todd project in Australia. And that was almost like buying an option. It was just giving them a seat at the table so that if that project or when that project comes into development and the company needs capital to develop it, they'll be the front runner to get a stream.
Mm-hmm. Yeah. Thank you for sharing that. So with streams, I was always curious about when whatever underlying metal that the stream is on, when a royalty, a streaming company gets the commodity at a cheaper price. I know that there's the smelter returns and such. What do they typically do with the gold? Like, is this something like a Sprott physical uranium trust where they just hold the gold? What typically happens when they get the gold at a cheaper price?
No, that's a good question. Typically, it's sold either immediately or within the same quarter. It's typically sold, but some companies roll gold typically or traditionally or oftentimes, I should say, has held on to the metal longer. I think more and more of the companies, now that they have very strong, solid balance sheets, are willing to hold on to the metal for longer. Obviously, earlier when you're in the business of providing capital to companies and you're continually spending that money and occasionally drawing down on a line of credit, doesn't really make sense to hold on to physical gold and silver because you can't You can't. Maybe you should be able to, but you can't use that for your next deal. But now you're seeing more companies hold on to it. And that's a good question, because you always have to watch when you're comparing this quarter's earnings with last quarter's earnings and the prior year's earnings, what the timing of the sales were, and are they holding some of the metal on the balance sheet?
Got it. Yeah, that's helpful to understand. So obviously we have the bigger companies, the Wheatons, the Franco Nevadas, the Royal Golds. What's your thought on the smaller competitors coming up in the space?
Yeah, I mentioned Triple Flag as being the fifth of the top five: Franco, Wheaton, Royal, and then a Cisco and Triple Flag. And there's quite a gap between the Cisco, Triple Flag, and the big three. And then you drop down. I mean, you drop down to sub 400 million market cap. So there's a big gap in the market in that middle area. And there's several of them at the 300 to 400 million market cap, things like EMX, Metalla, Gold Royalty. And then as you drop down, to the 50 and 100 and 150 million, there's a lot of smaller companies out there. So I do like the smaller companies a lot. I think you have to be a lot more, just as you do with exploration companies, you have to be more selective with junior ones. So the junior companies offer a positive, but there's also either a negative or something to look out for. On the positive side, the valuations of the junior royalty companies tend to be a lot lower than the valuations of the larger cap companies. So if you look at, and I'm going off my head now, but if you look at Franco or Wheaton or Royal, they're trading at 50, 60 times free cash flow. Huge. They're trading at 4 and 5 times book value. I mean, the kind of stocks that a typical value investor would run away from. If you look at things like, Metalla, Metalla is selling at about 60% of NAV. And so the spread in valuations between the smaller ones and the bigger ones is just huge. And so the real potential for the smaller companies as they grow is to get that bigger multiple, the higher multiple. What you've got to really watch for in the royalty space is, bigger actually is better, because a bigger company with more diversification in their assets, obviously the diversification in their assets implies or means that they have less risk from any one asset going belly up. I mean, you look at what happened to Franco-Nevada when Cobre Panama was shut down by the government. Cobre Panama was their largest stream, representing about 19% of their revenue, so very, very significant. Or look at what happened to Royal Gold when Mount Milligan was having problems 10 years ago. It was over 30% of their revenue at that point. Can you imagine if one of those assets had been the only asset that a $100 million company had? It would have just totally devastated the company. So anyway, as they grow, as they get bigger, they have more diversification, which lowers the risk. But the other really critical thing size does for the royalty companies, is it lowers their cost of capital. And remember, these are banks, as you said. They're like banks. They're providing capital to business. So a lower cost of capital is absolutely critical. And so if you're a Metalla or EMX or Gold Royalty, and you're looking at a $100 million asset that Triple Flag or a Cisco is also looking at, you're just not going to be able to win, because their cost of capital is so much lower than yours. And so when you're looking at the smaller companies, I think you need to really look at two things. One is, do they have a line of credit or a source of capital from somewhere That's critical. Are they actually able to get some money? And then the second thing is, do they have, because of that competitive nature that I mentioned, do they have I'll call it proprietary, but do they have a proprietary source of deal flow? That's really important. It doesn't have to be a proprietary source, but do they have some niche that they have that gives them a competitive advantage in that particular area? Because if they're going out competing in the public auction place against a Cisco and Triple Flag, they're just not going to be able to win on good terms, on good terms. So those two things are really critical, a source of capital and a source of deal flow. But as these companies grow, and it might be through merger and acquisition, because frankly, I think there's far too many of the smaller companies. And obviously a smaller company, just as with any smaller company, has a higher G&A. So if you can get some of these companies to merge and consolidate, enter that space between the, Metalla and EMX of 400 million and the Cisco, at 3 billion. If you can enter that middle space there and become more competitive, I think there's a huge opportunity for re-rating. Huge opportunity.
Yeah, definitely. Could you speak to obviously during the bear market after 2011, the performance of Wheaton and Franco versus the miners? Could you speak to that dynamic?
Yeah, no, that's an interesting point. I wish you were going to ask me all these questions because I'd have had the actual numbers at the top of my head. But if you look at, say, 2011, 2012, beginning of 2012 down to the beginning of 2016, that bear market there. Now, one thing I do remember is that the XAU went down 83%. The XAU, which is the index of 30 leading gold and silver companies, went down 83%. That's pretty astonishing, right? When you look at the royalty companies, and of course, I mentioned Triple Flag didn't start till 2001, so that's not even included in that comparison. But all three of the major royalty companies actually outperformed the XAU, and in fact were positive. They didn't just outperform by losing less than 83%, they were positive. So in a bear market, for royalty companies, the stocks, it's not always like that, but in a bear market, the royalty companies tend to hold up a lot better than the mining companies. It's also the period, and think about it, it's also the period when the companies lay the foundation for their future growth, because the miners are getting into trouble, right? Maybe they can't renew their line of credits at the right price. They want to do an equity raise and the stock prices are depressed, so they have to do more dilution. They're raising equity on lousy terms. And the big royalty streaming companies that have the capital are available to step in on good terms and sort of really lay the foundation for their future growth. And again, if you look at 2012 to 2016, let me just back up. For the 4 years before that, for the 3 years before that, Franco-Nevada, which was at that time the largest royalty company by far, Franco-Nevada did not do a single transaction. Not a single transaction. But 2012, 13, 14, and 15, they stepped up to the plate and actually took on debt for the first time in their history in order to do transactions. So the royalty companies are able to act in a very, very counter-cyclical manner, which is frankly essential in the commodity business because, we all know how cyclical the commodity sector is. And to be successful, you just have to be counter-cyclical. A lot of mining companies, I can't tell you how many companies I spoke to who said, oh, we'd love to do some consolidation. Oh, there's some, company in Mexico. Oh, there's some great companies in Mexico. We'd love to buy them. but we don't have any money and we can't raise the capital. But the royalty companies not only had the thought, but had the capital to do something about it.
Yeah, that's could lead to a massive opportunity for sure. So, Adrian, what are some things you're thinking about just as we wrap this up? What are some things that you're thinking about in terms of where you're allocating capital right now? And things of that nature. What are you looking at in the commodities market?
Well, I still like the major royalty and streaming companies, and we should say this not to leave people with the wrong impression. They are, without a shadow of doubt, the lowest risk assets and the best assets to own in a bear market for gold. But they also tend to perform well in a bull market. Now, I like to say that I don't expect Franco or Wheaton or Cisco or Triple Flag to be the best performing gold stock in a strong market, but I do expect them to perform at least as well as the index and at much, much lower risk. So to answer the question, but I wanted to get that in, but it leads into to answering the question. The royalty companies are, for me, a foundation. They're the foundation of a gold portfolio. We're talking about gold, right? When you said, where am I looking? Yeah. They, to me, are the foundation of a gold portfolio. We own, when I look at the major miners, we own some of the major miners, and we own them for different reasons. Like Agnico, for example, to me is the gold standard, and it is still undervalued. People can't wrap their heads around how a stock that has done so well in the last year and last 3 years can still be undervalued. But it's undervalued because as the price of gold goes up, then the inherent valuation of that company goes up. The price to NAV goes down. The price to free cash flow goes down. And so the valuation, on a valuation basis, Agnico Eagle remains undervalued. And then, we own a few of the major royalties, major mining companies. We own a few of the developmental companies. I'm not the type of investor that buys companies. This is just my style. I don't pick a company just because I think it's going to get taken over. Because we've seen how many times you can either be wrong or you can have to wait a long, long time before it's taken over. But if a development company might be taken over, that's a bonus. But we'll buy the good quality, and by good quality, I mean companies that have strong management and good balance sheets. I'm not a geologist, so I don't focus so much on the actual project and the drill holes. I focus much more on the management and the balance sheets. And then we own a lot of junior exploration, junior royalties, junior producers, junior exploration companies. But again, with a focus not on a particular project and next month's drill program, but on the company as a company. Is it a viable company with a business plan that will enable it to survive things going wrong, as things do go wrong in the mining business. So, but we're really spread across the board right now.
Yeah, thank you for sharing where you're allocating and everything. So, if you were to speak to the commodities university where you did the class on royalties, how would you sum that up for the audience? Like, what are they going to learn or dive deeper in than what we discussed today?
Yeah, I think a couple of things. One, definitely I hope they're going to learn what the real advantages of the business model, looking at the business model, what are the big advantages of that model? And I think the other thing that we didn't really talk about much today, if at all, what are the not only the advantages in the low risk, but what is the real leverage? What is the real upside that you get from these businesses? Because that is often overlooked a lot of people will say, yeah, I understand that they're low risk. I understand the advantages. Yeah, they have very, very high margins, and a small number of employees. Franken-Nevada has 40 employees. I think it's a 25 billion. Again, if I knew what we were asking, I'd have looked it up. I think it's a 25 billion market cap company in US dollars, and they've got 40 employees. Very, very few businesses can come anywhere close to that kind of ratio of employees to revenue. So people understand all that, but what they don't understand, what they miss, is the upside that is embedded into these royalty companies, the leverage that these companies have over the long term. And that's something we did talk about on the university course.
Yeah. Thank you for sharing that. So any final words for the audience before we wrap up today? Where can folks, I know you do asset management and such, and where can folks
Thank you for asking me.
Yeah.
Yeah, our website, the best website will be adrianday.com. And there you can see information about our money management and also information about our newsletter. We do have a newsletter. Money management, we do money management. We're just registered in Canada, so we do it for Canadians as well as for US people. And we manage in global markets, by the way. We're not only in gold and resources, but we do have, we have, our accounts are personalized. So a person can have a global account, a conservative global account with extra gold and resources, or you can have an aggressive gold account or a conservative gold account, whatever. And so we do that. The final word I think I would say, I've said this on a few interviews recently, so I apologize if people have heard it before, but the well-known Irish playwright and author Oscar Wilde talked about people who know the price of everything and the value of nothing. And I think that is something perfect to bear in mind at this state in the market, when the prices are up so much, but the values are still very, very compelling.
Yes. Thank you for sharing that. That is an important reminder, knowing the difference between price and value. So everyone, thank you for watching this show today. Be sure to hit the subscribe button. Also, be sure to go check out the commodityuniversity.com. Use promo code AdrianDay50, all caps, and you could receive a discount on your membership and access the courses, such as Adrian's course on royalty. There's courses on mining and things of that nature, understanding geology within the sector. So encourage you to go check that out and see if that is a right fit for you. Adrian, thank you for joining us today. Always a pleasure to have you on the screen with us.
Well, and thank you very much for having me, Daryl. And let me just, give a shout out as a word to Jay Martin. The idea, I assume it was his idea, but the idea of doing a commodity university is just wonderful, because I get questions all day long. And I think it's going to fill a very, very good niche. The other lectures I've listened to have been first class.
Yes. Shout out to Jay, and thank you again, Adrian.
Thank you.